Hi guys, welcome back to the MacroPillars Midweek Update, where we walk you through our daily process, how we're seeing the market through each pillar, what's standing out to us, and where we think the best opportunities are right now. This is how we apply our process internally each morning and how we work from top down into our bottom-up execution. So let's quickly run through the pillars and then I'll throw to Andrew, who will take you through the best trades on the board right now. All right, so pillar one, government and geopolitics. So our per jurisdiction risk rating has changed a little bit. And as this conflict extends further, those that were underprepared leading into the conflict will experience a worse score, and those who were well prepared will start to benefit. Right. So Australia, obviously the most underprepared, is still in that it's over category. Um, Political disaster, huge issues with the recent budget, highest inflation rate in the developed world, a central bank that's got a little bit over their skis, and of course the currency is generally susceptible to a risk-off environment. So the US still remains as risk-off, seeing as it's in the center of a geopolitical conflict. Japan has actually come back a little bit from risk-off to neutral. We know Japan has issues, right? But they were better prepared coming into this conflict, and they're benefiting from being pulled into this AI productivity cycle. So they've moved to neutral this week. Europe and the UK still risk off, underprepared, and there's obviously some political problems in the UK. So China was obviously very well prepared coming into this conflict in terms of their oil reserves. We've had the Trump Xi meeting pass, and although liquidity has been tightening in China, as Michael Howell wrote to recently, we're still putting them in that risk on category, and obviously Canada is benefiting from being an oil exporter. All right, so the dominant case, dispersion, still in that bearish limbo. So the AI strength is becoming further segmented into the semis, tech, and the AI-linked jurisdictions such as Taiwan and South Korea, and obviously parts of the metal complex, namely silver and copper. So as you know from last week's video, we've been tracking that silver and copper to gold ratio, and silver and copper have continued to outperform gold this week. And we don't really see how the AI trade can lose steam while that spread keeps outperforming gold. So that strength is increasingly isolated and is casting a shadow over the broader market. So the recent correspondence between the US and Iran has been marginally better, with Iran a little bit more enthusiastic than previously about the potential deals taking place. But of course, we've still had 60 days added to the timeline, and that's going to only create further pressure on the real economy. So the emerging markets, along with some selected developed economies, have been taking a pretty serious hit. Consumer confidence is at extreme lows, in fact, all-time lows in some instances. And while the bonds had a bit of a breather last week and into the start of this week, that's not necessarily bullish, depending on how far that bull move in yields continues. Speaking of emerging markets getting hit, what we're looking at here is an overlay of USD IDR, so that's the US dollar against the Indonesian rupiah in yellow, inverted. So as this goes down, the US dollar is strengthening and the Indonesian rupiah is losing value, right? So it's weakening. And the red is the Indonesian stock market or the Indonesian ETF, right? So this yellow line marks the 2nd of March, right? Obviously, the rupiah has weakened dramatically since then, and the stock market has taken a serious hit. And then this line is when they hiked by 50 basis points recently. So Bank of Indonesia hiked by 50 basis points. They're trying to strengthen their currency, and their currency is collapsing. And yeah, that is not good. So there is still plenty to do at the moment with a trading hat on, but in terms of serious macro allocation through our process, we are still in limbo, and we're preferring to play it through those energy dependent countries and what you need to eat. And that's still our general thematic, and we're just trading the ranges. But of course, as this dispersion continues and the outperformance becomes more segmented, keeps casting that shadow on the rest of the market, the balance remains tilted bearishly for macro pillars. So the key risks we're watching are fairly similar to last week. So we're looking at the Iran war. We're looking at the general pressure building on the bond market from all angles. Does this breather turn into a bull steepener? So we're watching Japan, private credit, Washington policy, any immediate messaging, and we have US PCE on Thursday evening Australian time. The conflict index from BBVA research remains fairly unchanged. We've seen a calm down in the Taiwan and China conflict ratings, and we've obviously seen Taiwan make new nominal highs. And just one chart quickly on watching Japan. So in yellow, we have Japanese 30-year yields, and then in black, we have that overlaid with all the rest of the global long-end yields. So the question we pose is, are Japanese long-end yields driving the rest of the global long-end yields higher in a competition for funding? MacroPillars has held this view for quite some time, and Ira Harris wrote a great note for us this week discussing the same topic, but I think we're coming to a really interesting juncture now because it's not only the long end, right? Now it's really the front end in Japan as well. And Governor Ueda gave a speech today that we will cover in the monetary and fiscal policy section. Okay, so liquidity. We're currently sitting for our year-on-year rate of change measure at negative 2.56. So we're still tight and risk off for liquidity. And then for our year-on-year rate of change, including the move, we're sitting at 23.58%, but that has come in from around 80% on the 20th of April. And if we look at an overlay of our net liquidity year-on-year rate of change, including the move with the S&P 500, we do notice that there is that clear dispersion taking place right now. And a really important aspect of our measurement of liquidity is the rate of change of the rate of change. So when we get a really sharp decrease of liquidity, it's quite instructive for risk assets in terms of weakness. And when we get a sharp increase in liquidity, it's fairly instructive for risk assets in terms of strength. As we saw coming out of those March, early April lows, we saw a huge increase in the rate of change of liquidity and risk assets followed. So with this recent tapering off here, if we get a serious elevation in the move, it does make risk assets kind of vulnerable at these levels. So if we get that elevation in the move index and we start to break down our recent key dates, particularly the 6th of May, which was the most recent quarterly refunding announcement, price is respecting quite well. If we break below the low of the 6th of May, we get deterioration in liquidity and the curve support it, we see risk assets as vulnerable. But until then, we're going with the flow and we're very happy being long US stocks and short energy dependent countries' stock markets. All right, now let's touch base with the Treasury and Fed operations quickly. So cumulatively, so far this year, we've had $118 billion worth of buybacks from the Treasury. So that's up 25% versus last year. And of course, we're up, 3,000% versus May 2024, where operations were fairly limited. And then if we look at the Treasury and Fed combined versus 2025, because remember in 2025, in May, we did not have the RMPs, right? So we only had the buyback schedule from the Treasury, not from the Fed combined. So if we look at that number and we compare it to where we're at right now with Treasury and Fed combined buybacks, we're at 342 billion, right? So we're up 261%. Now, whilst the Fed has tapered back their RMPs recently, gone from 40 billion to 10 billion, and the Treasury has brought in their buyback operations as they typically do seasonally around this period of time, this 261% number still should not be ignored in terms of positioning, market structure, and the levels in which these operations take place, as we've covered extensively, particularly around things like bond market volatility. So this is the upcoming schedule of Fed and Treasury operations, and it is very worth noting that on the 4th of June, we have $19 billion of Fed and Treasury buybacks combined, and then on the 11th of June, we have 12.5 billion. Right, so looking at the move index, it's very important to note that when we get a serious elevation and these operations come in size, historically, it does tend to calm bond market volatility. So if we get an elevation in the move index in the next couple of weeks, we really have to be conscious of those days in terms of our positioning and our risk management. All right, so monetary and fiscal policy. So we've seen quite a lot of basis points of tightening taken out of the market last week, particularly in the UK and Europe. The US, not so much, but yeah, we saw it in Australia too. So whilst this is super instructive intra-week, the implied rate and the current rate will still support jurisdictions like the UK on a relative basis. But if we start to see that implied rate shift towards the US's favor, with Australia and Europe following through on their current attempt at a bull move, we think we could see some serious strength in the US dollar against those currencies. Especially given the political backdrop in the UK, we've been looking at short positions in the pound as the recent rally has provided much cleaner location. And we have no change to the budget deficit percentage of GDP year-on-year rate of change table. But Japan is our leader, the US is in second place, and then Australia is the worst and deteriorating. Of course, the US still has a deficit problem, but they are improving. Just a couple of comments on monetary and fiscal policy. So as I noted, Ira wrote a great piece for us at MacroPillars this week, and I thought it would be worth putting in a comment from him. So he says about Warsh. With Warsh coming in and embarking on quantitative tightening, there is no way they will actually raise rates. They have to see how it plays out and what effect it has. because they will be curtailing bank reserves in a big way. And we know they already brought in the RMP from 40 to 10 billion. Walsh is smart and respects markets. Powell says he respects markets, but I don't think he does, because in 2018 he made a categorical mistake, as Druckenmiller dubbed it, the double shotgun approach. If you're doing quantitative tightening, you hold rates. If not, cut rates and see where it goes. I thought that was prudent to bring that up because there's a lot of talk around Walsh and whether or not he's going to cut or he's going to hike. And Irish shares a great point of view on the reality of the situation Walsh finds himself in. For Australia, following the RBA minutes last week and the broader suggestion that they may have got a little bit over their skis, hiking into what was largely a supply-driven inflation shock, today's in-line to softer inflation spurred an initial response that definitely interested us at MacroPillars. So Aussie yields have been collapsing amidst an unsupportive backdrop, as we've spoken to. So yeah, we've opted into a bit of an ambush trade today, and that was sell Aussie, sell SPY. And on Japan, Ueda's speech today was quite interesting, focused on different oil shock periods in Japan and made a lot of references to the currency value in response to energy prices. So it looks like the current setup is closest to 2022 when the Russia-Ukraine shock amplified by a weak yen helped drag Japan out of its deflationary regime. Right, so now Japan may be actually moving into a real reflation-inflation regime, hence the Nikkei and the bear steepener, right? Where oil, FX, wages, expectations, and firms' pricing setting behavior all feed into one another. Right, so must watch any action in that front end in Japan because they've certainly been dipping their toes in with the intervention, right? But the intervention will not work unless there's policy support as well. Okay, if we quickly have a look at the scorecard, we can see that the Nikkei is leading. We've got two extra dates there for the Nikkei, the 11th of July 2024, which was the 2024 intervention by the Bank of Japan. And we've also got the 30th of April 2026 intervention. So we've got a plus 14 there on the Nikkei, followed by the Dow Jones, the S&P, and the Nasdaq, and then lagging, we've got the FTSE, Euro stocks, but they are holding positive scores, but the only material bearish score on the scorecard is the ASX, which is why we are opting to stay with that trade. Obviously, the bond yields continue to all rip, and then for commodities, leading we have copper and oil, and then lagging we have silver, gold, and platinum. Platinum starting to overtake gold there and lead lower. And then for the ags, we've got wheat, corn, and soy leading with positive 12s. And then we've got a neutral sugar at 2 and cocoa at -4. For FX, dollar yen, followed by the Aussie dollar, and then the DXY. And then lagging, we have Kiwi, the euro, and dollar yuan. It has been the bottom of the FX section for months now. Crypto, fairly neutral. We've got XLK leading the sectors at a positive 12, followed by XLRE, which is the real estate sector ETF. And then lagging, we've got weakness in the healthcare and communication services sector. And then leading for the countries, we have Japan, followed by Canada, closely followed by South Korea as well. So we've got a bit of AI and energy independent mixed up in there. And then lagging, we have the energy dependent Germany and then also Brazil. And if we take a quick look at our proprietary trend reading, we have a lot of strength in the Nikkei, Russell, Nasdaq, S&P. We've got a lot of the Aussie crosses and a lot of the yen crosses. So we don't have a lot of strong bearish scores, but we do have a bit of weakness showing up in the bonds in the US. We've got the flip side of the Aussie crosses, a few of the Swiss franc crosses, as that Swiss franc has strengthened over the last couple of weeks, and then some good buying opportunities for sure on the grains, and then also we've got oil as well. All right, now I'm going to throw to Andrew. He's going to take you through the best trades on the board.
So this is corn, yeah.
Yep.
Obviously, there's the cloud. There's the 200 day, 400 days cross. So that's nice. We don't want it to breach the 2nd of March. There, have a chance there. Dates do work. And then obviously just run a Fibonacci against that. Yeah. So you're now into the 618, 764 into the cloud. So you want to be buying the zone with the stop loss under there. So basically buying into 457, buying into 449, and your stop loss is under 430, 438 with a tolerance. Yeah. Okay. So little, it's now also a range higher week in, but not a great one. But again, as you saw that one down there, right? Once you got under it, not happy. Once you got back above it, happier. So I want the market to be above 470 to be really happy, yeah. And then if it's really real, then this is the swing count. We'll take it to that count, yeah. But all we can do is deal with the current sell-off, and that is basically into this zone. That's the corn, the wheat. You get it's a similar picture really, and you're comfortably higher in the year in the quarterly cloud, which is nice. So it certainly can go up there. It'll be that extension that'll take it there. Work to do. And then monthly's fine. Weekly is yeah, it's fine. You know, again, good crossover on the averages. That's 204 a week. And comfortable, we're only just coming back into the daily balance line. Now, where can it come down to? Well, if you believe in the trade, again, 2nd of March, again, do you believe the dates or don't you believe the dates? There's your zone, got a chance, bang. So that's where I think it's got to. So let's do a Fibonacci against that. And there's your zone. If you're not buying at 611 and you're not buying at 6593, stop under these, don't. And then 200 400 day is just crossing. Right. So they haven't, let's have a look when it last crossed. Since here, March of 23. We're now crossing in as a bull with a 200 going above the 400. Compelling. Soybeans, the same. You've crossed as a moving average, which is, something I watch a lot, but again, hasn't been in that position since 23. They're all in the same structure. So yet again, you got to show up into this zone, which is the 2nd of March, right? There's 2nd of March. There's 2nd of March, is it? Yeah, so there's 2nd of March. So that was the hustle. I mean, it kind of it fought against it, as you can see, but it was pretty powerful price. Right? And then you had a chance and off it went. Now you get a chance to buy it back. So what do? You do exactly what you should do, and you buy into the 618764, which is now. They're all doing the same. And then obviously, we like it against Australian stocks. So let's go short. Hang on. Long corn, long wheat, long soy, short SPY 3 times. Obviously, the wheat, the ag sell-off is currently retracing. So as it goes up, you're long the SPY, short the ags, as of course since the 2nd of March. There it is there, right? And that owes me that retrace that extension. So you take your Fibonacci from that extension and go, it owes me that. Hit the 618, fair enough. But not a reasonable reason to stop there. Take a breather and take that extension. So next step should be 1486. Where am I wrong? I don't want it back in above that high. I'm going to wait that long up there. Just don't think it should go above that high. So 1532 and current price is 1905. That's a decent move, isn't it? 24%. Is that right? Again, I don't see any reason to not want to be leaning back into selling the equities and selling and buying the ags. Now, again, outside range lower week on that chart. Not that happy that it was back above that low. Hence why we took some risk off. It just can't go above that high. At 2067. So that's the retracement I'd be trading. And certainly And then you just got to, go into the legs on, I'm preferring the Australian stock market for the reason we've articulated for some time. Then we've got the Australian inflation data out today, so we'll have a look at that. And if that's strong, then I think it puts more pressure on the Australian stock market. If it's soft, the Australian stock market will probably try and rally. I don't think it'll work, but it'll give you a chance to sell. But Australian stock market is there, and it's obviously oscillating, but it's certainly under pressure. So it's like everything at the minute. You've got Taiwan completely ripping. Oh my gosh, look at that. It's a Taiwan index. There's AI. It's not stopping. Kospi, Nasdaq. So that's interesting. It's not making new highs, but everything else is. Yeah, I mean, for me, again, it's short buy that dip into the commodities, sell the rips on any stock market. I preferred now to be in Australia than DAX because DAX is performing better. But as you can see, what I have also looked at is being long US stocks and short Australian stocks. Um, Using the Dow, and that's obviously doing very well. So there's a higher extension there. I see every reason why you want to be long US, short Australia at the moment. So it's the other trade that I've now, well, we've gone into for some week or so. But so yeah, continuing to be pressing that, you know, until we see any evidence of, the dispersion and the challenges continue. You're seeing that challenge through Indonesia, hard rates last week, and the stock market's getting hit, and their currency's getting smoked. That's not good. So I don't think any resolution they're trying to achieve through the Middle East is necessarily coming through the price because it would be coming through the emerging markets more so. Yeah. What's India doing? That's the Indian stock market. And it's remains it's better, but remains challenged. And their currency is a little better. So yeah, I just think it's continuing to be aware of the dislocations, the dispersions, as Ira up to yesterday. They're everywhere, and you're just going to manage that path. At the moment, it's not. Unless you're just basically all in AI, which is good for you if you are. Um, the rest of it is really just a bit of a chop fest, and you've got to trade it and invest accordingly.
Okay, so just a quick look at market structure. So the broad equity positioning is still pretty long through the CTAs and the systematic funds. The COT positioning is quite split, like still got that dispersion. The most crowded trades long are the Nikkei, gold, the ZAR, silver, copper, platinum, Aussie dollar, and oil. The market is still heavily short the Swiss franc, the Kiwi, the bonds in the US, the pound, the yen, and they are actively selling the Dow and the S&P. So market structure generally is quite calm and is assisting equities higher. Of course, there's no reason for the systematic flows to turn into forced selling yet or forced deleveraging yet. But of course, we're in a sensitive environment right now. So if volatility does elevate, we can easily shift from supportive to a modest deleveraging. Coming to our active position matrix, we have a few changes from last week. So we took our money and ran on the metals as they just don't seem to be able to make a decision. Our highest conviction trade is short the SPY times 3, long corn, wheat, and soy. We've been trading the range from around those 2nd of March levels. The next trade we have had on for some time, but we added to it today in a bit of ambush fashion, which is short Aussie, short SPY after that inflation number today. And then the other trade that we've had on is long US via the Dow and short the SPY. So we'd love to leave you with one quote, and that is, you must always see the market through the lens of the day. You cannot view today's market through the lens of yesterday's, last week's, or last month's profit and loss. The moment you do that, you're done. You've got to keep your lens clear. This is an adage that we consistently come back to internally at Macro Pillars. You must see the market through the lens of the day. All right, guys, that's it. So I hope you enjoyed this week's midweek update. If you did enjoy it, please like and subscribe. And as always, watch what they do, not what they say.